Next up, for our final topic, we have land values, and here to discuss that is Doug Hensley. Doug joined Hertz in 2017 as president of Hertz Real Estate Services here in our Nevada, Iowa office. Doug has actively served the agricultural marketplace since his graduation from the University of Illinois with a Bachelor of Science in Agricultural Economics and a Master of Business Administration. And with that, Doug, I'm going to turn it over to you.
Thank you, Casey. It's good to be with all of you today again. There's been a lot that we've covered already, and boy, there's still a lot to talk about in the land value sphere. So let's jump right into it. If you could pull up that presentation, Casey. In terms of what we're going to cover today, I'd like to cover three big buckets, basically an update of what has been and is happening in the marketplace. Secondly, what I see as being important to driving the current market. And then we'll finally talk a little bit about expectations coming in to 22 and for the balance of the year, because we are already through a quarter already. How'd that happen? As I start out today, I'm just going to remind you, I've always said, and I'm always going to say that farmland values are a really good barometer for everything that's going on in the countryside. If things are going well in the country, you're going to see it reflected in farmland values, and likewise, if things aren't going so well, that will show up as well. So how do things look in our current world? Well, for the entirety of 2021, and now for the first quarter of 2022, that barometer that I mentioned has pointed toward one thing only, and that's much stronger land values. This table and the chart that I'm showing you is from the Federal Reserve Banks. There's 5 Federal Reserve Banks across the heartland of our country. And somewhat incredibly, the reporting from each of these district banks shows much stronger land values year over year at the beginning of 2022 compared to where we were in January of 2021. And from my perspective, I'm not sure that I've ever seen such a consistently strong increase in land values regardless of where you're at. What's more typical is you'll see 1 or 2 of these district banks reporting stronger values, and you'll see 1 or 2 of these banks, somewhat sideways or maybe a little weaker depending on what's going on in their geography. But here what we have for the past year has just been stronger land values. Incredible market that we've been looking at. Zooming in a little closer to home here in the upper Midwest specifically, we began 2021, so a year ago, with stronger land values, and that strength in the market just continued to accelerate throughout all of last year. And looking at this data from the Chicago Federal Reserve Bank, this was released about a month ago in the month of March. It reflects stronger land values across the board for the upper Midwest. And depending on where your farm's at, you can see some differences on a quarterly as well as year over year basis. And one of the things that I wanted to point out is the reality in my mind. I'm not sure that the Chicago Fed or any of these district banks have yet totally caught up with the market, because for the October 1 to January 1 quarter, that the Chicago Fed is showing reporting of 7% stronger on average during that quarter. I would argue it was a little stronger than that last fall, and certainly year over year, I think you can make an argument that the market was on average for the 7th district more than 22% stronger year over year. So I think the surveys always lag what's actually happening in the market a little bit, and that's definitely in play here. I guess big picture, looking back, I've been at this for roughly 25 years. I've never seen such a strong market as what we've experienced in the upper Midwest over the past 12 to 18 months. So it's been a really exciting time, a lot of fun. Hold on to your hats is what it's been like. Now, for those of you who own land in the state of Iowa, we'll zoom in even closer to home and focus there. This is a report that comes out from the Realtors Land Institute twice a year in September and March. And so the March release just came out from the Realtors Land Institute. And this is really a measure of responses from land brokers, auctioneers, bankers, others that are really dialed into the market all the time across the entire state of Iowa. And what you can see here is a little greater than what the Chicago Fed showed, but almost 33% year over year increase in values. And keep in mind when I'm talking about these returns this is only appreciation. This does not factor in any of the cash return or the income that's generated on an annual basis by farms that you own. So this is just pure appreciation. So pretty neat asset to own when things are going like this. As you can see, the market's really been on the move. And I also included in the slide deck here, because we have so many people who are watching that do own Iowa farmland, I included the 9 crop reporting districts, so that when you get to slide deck, wherever your farm's at, if you're in the state of Iowa, you can take a look at what high, average, and low quality land in each of these 9 crop reporting districts is showing. And this is a study from Iowa State University that comes out at the end of every year, and it showed up to 35% increase in value depending on the district. So there are some differences. For our friends over in Illinois, which that's where my roots are, the Illinois Society of Professional Farm Managers and Rural Appraisers also publishes an annual land value survey that comes out every March at the end of March, and this is just fairly fresh information. And that survey in the state of Illinois showed similar increases in value to the other reports that I've mentioned. Across the board, pretty consistent 20 to 30% increases in value. Kind of depends on what the land class that you're talking about. From a productivity standpoint, excellent, good, average, and fair is how the Illinois Society breaks down land values there. And the one thing that I do want to point out, on the right end of this graph, you can see the steep increase in value in all of those classes, but the steepest increase in value, and I think this could be said for Iowa, Nebraska, Minnesota, it doesn't matter where you're at, the steepest increase in value is coming in that top end, kind of the Class A type of land. Not that B and C quality land also isn't increasing substantially, but the gap is growing. That's what we've seen over the past year or so, is that the gap between the really high end, top quality, best quality in any particular geography is outpacing the increases that we're seeing in the second and third tier. So keep that in mind as well. So now that we know where we're at with land values in terms of what's happening in the market, let's talk a little bit about what's driving this market. This is really one of the important things for you as a landowner to understand is, okay, all the things are happening. How's this going to impact my farmland holdings? Obviously, there are several things in play as to what's driving the market, but one of the most prominent is the price of corn and soybeans. And Dick and Jeff both talked about corn and soybean prices. There is without question a very direct link between the strength in corn and soybean prices and the price of tillable farmland. And Dick showed a really interesting slide earlier that showed what corn and soybean prices were a year ago this time, as well as 2 years ago. And when you think back to the summer of 2020 with the COVID lockdowns, we saw corn prices that were, around $3 or maybe a little bit better in the summertime months, but $3 corn and $8 or $8.50 soybeans. And from a land market perspective at that time, we were just kind of stable and we were drifting sideways to slightly lower. Then the derecho it moved through in August of 2020, and the grain market started to come alive late in 2020. And that march higher in grain markets helped excite the land market. And we saw the land market really move through the end of 2020 into 2021. And really into the spring of 2021, we saw continued commodity price increases, which again gave that much more strength to the land market. Then the commodity markets in 2021 kind of peaked in May. It was almost a year ago this time that we saw the peak in both corn and soybean prices, and we drifted sideways to lower, but land values were on fire. We started to see some sales in early summer months that I was surprised at. We saw the first $15,000 and $16,000 and $17,000 an acre sales that happened in June, July, and August. And as we chewed through the rest of the year into the fall and winter months, that acceleration just continued. And from a land sales perspective, I guess I've learned not to be surprised by anything because we've seen strength in this land market, particularly here again in early 22, with commodity prices going so much stronger with the Ukraine situation and just all the uncertainty in the world. We're reaching levels we've never seen before on commodities, and that is providing fuel for the fire in the land market. And we've seen 20 and 22 and $25,000 an acre sales for land that would have been unthinkable 2 or 3 years ago. Can it continue here for the rest of the year? We'll talk a little bit about that here in a minute. But the reality of stronger commodity prices leads to this expectation of higher incomes at the farm level. And if we look at the USDA data that has most recently been published, net farm income in 2021 as a whole was the strongest that it's been since 2013. You can see on the chart, the gray part of the chart is showing basically corn and soybean and livestock receipts. The red part of that chart is government payments that are added onto that. In 22, USDA is actually early this year forecasted net farm income to be down. It's not because our corn and soybean prices are going to be down. It's because government program payments are going to be trimmed this year. I suspect that the increase in corn and soybean prices that we've experienced the last 60 to 90 days may position this overall income situation for 2022 to find the highest level that we've had, certainly in the past decade, by the time we get to the end of this year. So I think there may be a revision to this chart, but I want you to understand that we've seen a real reduction in government program support because the market has provided tremendous profit potential here in the last 18 months in particular. And I thought you might find this interesting. I've showed this chart one time before to see the breakdown of recent years government program support. Because if you look back to 2019, 2020, and even into 2021, government support was really important to agriculture and to maintaining just the stability that we enjoyed in the land market during that time. And as you were probably aware, again, if you picked up the farm magazines and would look, it wasn't just any one single program of support that provided that stability. You can look here on the chart and see there were 3 big categories in 2018 and 2019. One was a market facilitation program that was designed to support the uncertainty that entered the market with all of the tariff situation that we dealt with in the prior presidential administration in 2018 and 2019 and into early 2020. And then when COVID hit, like all industries, agriculture was really disrupted. And so we had the coronavirus fruit assistance program, tranche 1 and tranche 2, along with the producer paycheck program that provided support to agriculture. So I guess this slide just amazes me because it reflects how much revenue was pumped into agriculture the past 3 or 4 years. And I think it helps explain why the farmland market from 2015 through 2020 didn't suffer a worse pullback than it did when commodity prices were not where they are today. We're really enjoying high commodity prices today, but it hadn't been this way for very long, and we hadn't had very strong commodity prices really until 2021. That's important to understand. So a next propellant for this land market in the past couple of years, and particularly, has been the generationally low interest rate environment that we've enjoyed. When COVID hit in early 2020, mortgage rates plummeted to all-time lows. And if you went out to get a mortgage on your house at that time, you could get 2 or 3%. 30-year fixed rate money to borrow and buy a house with. That was similar to what happened in the farm mortgage market, and that low interest rate environment continued through most of 2021 and into early 2022 here. But that tide has really started to turn here in the last 60 days, as you can see on the chart. For the first time since 2018, we're seeing a 10-year treasury rate, which that 10-year treasury is really important to long-term interest rates. We're starting to see that treasury rate get close to 3% again. And that doesn't sound very high. I often say it doesn't sound very high to me. But when you considered that a year ago when we turned the calendar into 2021, the 10-year treasury was about 1%. And here earlier this year, when we turned the calendar again into 2022, it was at about 1.5%. That tells you how much rates have really started to move here in the last 90 days. And I looked before I came on camera with you here today, we're seeing the 10-year Treasury is at 2.92% today. So it's almost doubled here in the last 90 days or so. That has a really big impact on the mortgage market. Because if you follow through how interest rates are set at your bank or with Farm Credit, most of the financial lenders are putting anywhere from a 2% to a 4% margin on top of the 10-year Treasury rate. So if you have a 10-year Treasury that's at 1%, like it was a year ago this time, and then you add, let's just call it 3% on top of that for margin, that gives you a long-term mortgage rate of 4%. Well, when that 10-year Treasury gets closer to 3% like it is today, and then you add on the 3%, that takes that rate that is charged to a borrower up towards 6%. So you're starting to see some meaningful changes in interest rates that are charged by lenders, and that's ultimately going to have a little bit of a headwind effect, I think, in this farmland market, as well as in markets for residential property and commercial property too. Maybe a little bit of a headwind for real estate overall. Some may be asking, why is this interest rate environment changing? Well, the policymakers that we have at the U.S. Federal Reserve banks have started to change their posture as it relates to interest rates because of inflation. We haven't talked about inflation for the past 3 or 4 decades, or at least meaningful inflation for the past 3 or 4 decades in our country. But if you've been watching any of the popular press, you're seeing inflation readings are running north of 8% right now, year over year, and that's a really significant difference. The Fed's goal is for inflation to be closer to 2%. So anytime we get an overheated economy, one of the ways that the Federal Reserve uses to cool down the economy is to raise interest rates. And that's essentially what we're starting to see. And we saw the first interest rate increase come through in March. 3 to 6 months ago, there was an expectation that we may see 3 rate increases during 2022 calendar year. I think that expectation is now closer to maybe 7 increases between now and the balance of the year. So low interest rates have been really important to driving and asset values and supporting land values, but with the reality of rising rates in 2022 to get inflation in check, it's going to be really interesting to see how that ultimately impacts our land market. So far, in my opinion, higher grain prices, the positive coming out of higher grain prices, have more than offset the reality of the rising interest rate environment. At some point, that may not be true, so just pay attention to what's happening in the interest rate world. This next slide gives us a little historical perspective on interest rates and the environment that we've had. This shows interest rates that are charged at the 5 different regions of the United States over time, and there are some differences. The Chicago Fed typically reports banks in their reporting region have the lowest interest rates, while the Dallas Federal Reserve traditionally reports the highest lending rates. The different rates factor into different risks for the region of that particular geography. And if you look down in the Dallas region right now, it's cattle, oil, and wheat are the things that drive profitability at the farm level and really in their economy. And those are historically very volatile assets, all of them. Here in the Chicago Federal Reserve Bank region, we're pretty basic when it comes to corn and soybeans. We don't have a lot of volatility in our growing of corn and soybeans because we have such rich soils, and we're really blessed to have stability in our growing environment. So that plays into lending rates. And here's just another representation of those lower rates. All throughout 2021, rates just continued to drift slightly lower. And when you look at the prior 5-year average, you can see how meaningful the difference has been in this recent rate environment from the prior 5-year period. Now, when we get an update to this slide as we approach the summer months here in 2022, the drift lower in this slide will definitely reflect a reversal because, as I mentioned, interest rates have turned around and are headed the other way. So that's something to again, be paying attention to. Finally, as it relates to banks and lending, This slide is a really important measure for lenders across the 5 Fed bank region. It's something that they watch really closely, and that's repayment capacity. Essentially, repayment capacity is a measure of the ability of borrowers to pay back loans. And in the past 12 to 18 months, this measure has really improved greatly because borrowers look better. They've been able to make more money, and they look much healthier when it comes to, a loan committee at a bank evaluating them as a potential borrower. Again, we haven't seen bank repayment capacities this high since going back to 2012 and 2013 when we enjoyed really strong grain prices at that time too. So again, stronger crop incomes really help to create stronger ability to pay back borrowed money. Thus, we have an increase in competition for land. Again, for those who are borrowing money moving forward, when those higher rates eventually take root, it may slow down some of that competition. Now, a last factor that I want to talk about as to what's been driving this market, and this one's also been really significant to the support in the land market and land values in recent years, and that's the reality that really from 2015 through 2020, we had a really tight inventory of farms that were coming on the market and being offered for sale publicly. And as this chart shows, publicly marketed farmland sales were down substantially in 2020, and they had been down for several years. If you look at the chart again, the 684 sales that happened in 2020 versus looking back at 2012, they're, just over half of the sales volume in 2020. So even in a weak environment from 2015 through 2020, because volume was down, we still had people that were interested in buying farms. And so supply and demand were somewhat in alignment. And this is showing Iowa land sale volume. If we looked at Nebraska, Minnesota, Illinois, Indiana, or anywhere else, we would see very similar numbers to what we're seeing from Iowa. Now, with the market-wide price increases that we started to see in early 2021, we've seen a higher number of farms come to the market, and that just stands to reason through last summer into the fall and now through the winter months. I initially thought that when we looked back at 2021, we may see a record number of sales having occurred in 2021 because any brokerage and auction company in the fall of 2021 had never been busier. But as I thought back on the entire calendar year of 2021, what was happening a year ago this time? Vaccines were actually not widespread yet. We were just starting to see people kind of come out of hibernation from COVID. We were seeing widespread vaccine distribution happen in March, April, and especially May. And so the first 2 quarters of 2021 were not super busy farmland sales quarters, even though the market was strengthening during that time for the sales that were happening. The 3rd and 4th quarter of 2021, certainly on a quarterly basis, would have been records in terms of volume of sales that have happened. And it was really interesting to watch the market in the fall move through and absorb the increase in the sale volumes that happened last fall and winter. I was concerned about all these farms coming to sale to the market all at once. Is there enough demand to absorb the supply? And what we found is the market just worked through those sales, and we saw prices continue to increase, even though we had an incredible supply of sales coming to the market. So it was a special market last year, and really through the winter months. It's important to understand that's not always the case, but it certainly has been for the past 12 months for sure. This chart it comes to us from the Kansas City Federal Reserve, and it describes that relationship that I'm talking about when it comes to volume of land sales and the strength in the market and how that works. Basically, what this chart shows is that when land values are stronger, people will bring more sale volume to the market. People love to sell into a strong market. Likewise, on the flip side, when things are not going so well in the market, people will hold off on selling because most people don't want to sell a farm or any other asset into a weaker marketplace. And the cycle will continue. When high prices ultimately bring more land to the market will eventually soften as supply and demand get out of whack, and this wave will continue over time, just like it always has. So really interesting thing to understand about the market is how volume impacts prices. So what's been driving this market? Several interrelated factors. Higher commodity prices certainly overall farm income and profitability. The government support that we've seen through 2020, not so much for the past 12 months or so, but government support during that time, that period helped maintain stability. Low interest rates, which again appear to be shifting the overall banking environment, and historically low volumes. To put a bow on this part of the discussion, we normally see, again, one or two positive factors driving the market higher and one or two positive or negative factors that will drive the market lower. In the past 12 to 18 months, most of these factors were aligned in a really special way. And I think that's why we've seen the increase at the levels that none of us have ever seen, because all these things were aligned. And so when we start to see some of these shifting like we are right now, that's when you'll want to keep your eye and know that the market may be working a little bit different in months to come. Now, I'd like to switch gears just a little bit and answer another question that we often get asked, and that is, who's buying farms right now? So I want to just touch briefly on this topic. Without question, the vast majority of farms are being purchased by farmers still. It depends on the state that we're talking about, whether Illinois or Iowa, Minnesota, or exactly where we're at, but farmers are absolutely buying the majority of farms in any of these states. The next category of buyers that I like to talk about is local investors, and that means non-farmers who own the land but live locally to their land. I'm sure many of you would classify as a local investor. You could be a banker, an attorney, or a school teacher who owns a farm, but you don't farm it yourself. Likewise, we have some non-local investors who own farms, and these are folks who live out of the area from their property. They're not a big pension fund or huge investor by any stretch, but you understand that there's farmland has awesome investment qualities, and often we have folks just like you who are tuning in who qualify as this non-local investor. And when we look at the marketplace, anywhere from 10 to 20% of the market, depending on the exact area, is made up of local and non-local individual investors. Then we have the institutions that also participate in our farmland markets in many of the states across the Midwest. There are different types of institutions that I want to mention here. There are the major institutional players that are in retirement planning, in that retirement planning sector, that allocate a small percentage of a multi-billion-dollar portfolio towards buying farmland, some of which may be row crops in the Midwest, some may be permanent crops on the coast or around the world, but the John Hancocks and the Prudentials and UBSs of the world, many of you have heard of those before. They are active in the farmland market across the country. In the past 15 or 20 years, we've also seen new institutional money in the form of more targeted agricultural funds enter the marketplace. Summit Farm, Ceres Partners, Homestead Capital are just three that are very active in the Midwest. These are agricultural focused funds that have seen success in buying, improving, and generating income off of farmland across the country. And more recently, we've seen crowdfunding individual farms come to the table. It's a new way to own farmland. Acre Trader is an example of one of those institutions that they will essentially get a farm under contract, they'll put it on their website, and retail level investors can purchase shares in an LLC that will own the farm, and the retail level investment will be anywhere from $10,000 to $50,000 of investment, and you'll be essentially a minority owner in that LLC and own with other people who also want to have some exposure to farmland. So crowdfunding individual farms has become more mainstream here in the last 3 to 5 years in particular. When I add the institutional ownership together, whether it's the bigs, the newer institutional investor, or the crowdfunding, you're looking at 5 to 10% of the market is influenced by those type of investors. So not a huge majority, but they are active, in particular in the state of Illinois, Wisconsin, Indiana, and a few other places. Not so much in the state of Iowa because of institutional ownership limitations, particularly for the big institutions. And here's why. all the investors, regardless of how we would classify them. Here's why they're interested in owning farmland. It's because farmland is a winner from a financial perspective. And this shows financial performance for the last 30 years. I don't have full year data analyzed for 2021 to add to the chart. I will here by summertime. But over the past 30 years, farmland has really proven to be a really consistent winner. And if I showed you a 40-year chart or a 50-year chart, farmland would be a winner there as well. Longer term charts, 40 and 50-year charts, actually show better stock performance than what this chart reflects, but stocks still do not outperform farmland when we look at 40 years or 50-year time horizons. And when you look at this chart, you can see on the left-hand side the average annual return of the asset. I added several different assets, Dow Jones, composite REITs, which are commercial type of property ownership. We have bonds in there. We have gold. And then we have farmland up at the top, which we've added different states, Indiana, Illinois, Iowa, Minnesota, here across the Midwest. You can see the average annual return in that left-hand column. Then go over to the right-hand columns, and we have the minimum return over that 30-year period on an annual basis, as well as a maximum return. The 2021 year, when we add it, is going to obviously take out for farmland a lot of the maximum returns that were reflected over that 30-year period, because we've seen such awesome performance over the past 12 months. But what I want to point out here is the minimum returns that we see in farmland compared to other asset classes are very small. Farmland can go down in value. I want to say that very clearly, but historically speaking, it has not happened in a significant way over the past 30-year time horizon. And looking at maximum returns on an annual basis, farmland can really fly. Compare that to the Dow and some of the other asset classes, and those asset classes can really sail strong too, but they have a little more volatility in their returns, and that's the point that I think farmland just has a real stable path. So something to understand about farmland as an asset class, and that's why a lot of folks find value in owning farmland. So what to expect moving forward through the rest of the year? Let's get our crystal ball out, and we'll talk a little bit about what we might expect going forward. I want to show you a little bit about attitudes in agriculture, something that we don't talk about often enough, I think. And it's a really important thing to understand about agriculture in general and the land market specifically, is the fact that all these markets are just driven by attitude and intuition of the people who work in it, in that sector. So watching and listening to certain measures about attitudes, I think, can be really helpful and help us understand what may or may not be coming. Purdue University publishes a monthly gauge of farmer sentiments on different topics, and it's pretty granular. It's a measure of 400 different farmers each month. And I want to note that this isn't necessarily specific, this particular chart, to the land market, but it gives you a little bit of a sense as to what is happening in the minds of farm operators at any given time. If we look back at the past, several years, we can see a real zigzag. Looking back towards the left-hand side of the chart, we see confidence really improved in 2016. I think that had to do with the farmer optimism with a change in administration at that time. I won't talk whether it's one administration is good or bad, but this reflects what has happened in the countryside and how attitudes improved. And then we kind of chop sideways and lower. And through 2018, 2019, it was a tough time with the tariff situation in agriculture. Attitudes kind of soured because things weren't really very easy. And then coming into 2020, we saw a lot of strength in attitudes. Part of that had to do with we finally figured out the new NAFTA agreement with Mexico and Canada. We also in early 2020 were able to figure out the China trade deal, and that brought a lot of optimism into the market. And then what happened? COVID hit. Wow, we about bottomed out, and then we came through COVID and we saw grain prices strengthen, and we were at new highs through a good part of 2021. For the past 6 or 9 months, we've seen attitudes kind of go sideways to lower. And I think part of that has to do with some concern that people had in tax policies that were being proposed here in the last year, as well as the fact that we've seen higher input prices really come into the market. It takes some of the starch out of farming operations when they see higher prices, and that's really reflected in attitudes. This is a chart from the most recent Purdue survey where they asked a question about concerns for the next year. And I think this is, again, coming off the attitudes chart that I just showed you. 4 main issues take the cake here. Commodity and livestock prices, are we going to be able to maintain high levels? People are concerned about that. Higher input costs, that's a huge concern and takes the top prize as to concerns in agriculture. And then we have government policies and COVID impact rounding out top 4 concerns. As it specifically relates to land values, I want to tell you short-term attitudes are really positive and have been for the past 2 years. Look at how much things changed from April of 2020, 2 years ago, where things were really negative, to where we're at here in early 2022. So amazing turnaround for sure. In longer term, from the same Purdue survey, we see that farmland price expectations in the long term are tailing off just a bit, although they remain high. But this is an interesting graph. I think this is interesting because it shows even when things weren't great in agriculture, people expected land values to be higher in 5 years than what they were. And I think that speaks to the resilience of the asset class. People just want to own farmland and know how important it is to control farmland for their farming operations. Beyond just asking people for longer term land value expectations, early this year, Purdue also started asking respondents to their survey why they thought land values would continue to appreciate. And it seems like there's 2 big issues that are in play here. And the 2 main answers that people responded was they think investors are going to continue to seek and compete for farmland. And then, of course, inflation concerns, which are inflation, again, is at the highest that we've seen it in 40 years. So that's playing into people's mind. They have an expectation that land values over time are going to continue to go up just because of basic inflation in our economy. Before I conclude here, I wanted to just quickly touch on a rental outlook for 22. Given the date that we're at, obviously most leases are locked down for 2022, but it was clear that the lease trend coming into 22 was higher. Interestingly, this chart came from the University of Illinois and was put out in late 2021. So it's not 120 days old, but the prices that the University of Illinois was using for this current year was $4.50 for corn and $12.35 for soybeans. Boy, we can chuck those out the window, can't we? Now that corn's $7 or $7.50 on the new crop and beans are north of $15, it explains some of the strength in the rental market. And I know Jeff talked a little bit about that and how it's not all roses, because we've seen input prices gather quite a bit of strength as well. And that's offsetting some of the potential income capture at the farm level. But again, coming into 2022, there was some expectation that we're going to continue to see a little stronger rental values around the Midwest. Around our company, we always try to be really careful with making very broad brush statements about rent should be up $50 an acre or $30 or whatever, because how much rent should be going up or down depends on your specific situation and often depends on where you're starting from. So just remember that as a landowner, that it's really important where you're starting from as to what things should look like moving forward. And my last slide here that I'm going to show you is again from that Purdue University Ag Economy Barometer, and it shows from a producer's perspective, they were actually expecting rents to be higher coming into 2022. So farmers are really, they're wise. They understand the market and they understand what to expect coming forward. So again, pay attention to some of these different outlooks and surveys, and it can fill you in on a lot about what you can expect. As I wrap up here, the things that I would encourage you to pay attention to in the coming months that may give you a little bit of clue as to what is happening in our coming farmland market. Commodity prices are chief to watch. we peaked in 2021 about a year ago this time. It was in May. What happens this year? Boy, it's been wild already, and I anticipate that we'll continue to see volatility similar to what Dick talked about earlier. Interest rates and inflation are going to be a really chief topic as well. How hard's the Federal Reserve going to push interest rate increases? It will be really meaningful to know the answer to that as to what's going to happen in the farmland market as well as the residential and commercial markets, because that's going to impact and already has impacted lending rates. Sales volume of farms was way up in the third and fourth quarter of 2021. We had pretty strong volume in the first quarter of 2022. Will the market strength hold that we've had through that time period? It'll be something to pay attention to. And finally, we need to pay attention to what's going on policy-wise. Farm policy is really important. We're going to start hearing about renegotiation of the Farm Bill here in the coming months. I think crop insurance is something that we need to talk to our legislators about to make sure that crop insurance is factored into our coming Farm Bill in a way that in a similar way that it has been, because it's been really important to maintaining stability in our farmland market. And then tax policy under the Biden administration, the Build Back Better bill, the first creation of that did not get pushed through in late 2021 in the way that it had been proposed. And there were some pretty substantial tax policy changes that were being proposed. It's being discussed right now whether a smaller version of that can be pushed through legislatively here this summer. And whether that happens or not, it could impact capital gains tax rates, a step up in basis, 1031 tax deferred exchanges, and other things. So pay attention to the policy arena, because there's a lot of things that can come into play with that, and that'll impact the farmland market. So, Casey, that brings me to the end of the comments that I had, and I look forward to the question and answer session that we have coming.